Hi, people. Thank you for stopping by Building Wealth with Rajeev. All of you would remember that a couple of weeks ago, we started a series, Stock Investment for Beginners. And we released first video, 7 reasons you should invest in stocks now. It was received extremely well. So thank you to all those people who congratulated me, who wrote their messages to me, sent their WhatsApp to me. Now, here is episode 2, which looks into 7 criteria you need to take into account to find a great business. So I think let's get started without any further delay. 7 criteria to find a great business. Now, in the beginning, it's very important for you to know that for beginners, we are talking about this stage of business, mature growth, mature, stable, and to a certain extent, even high growth companies. We are not talking about startup companies, young growth companies. Each business has its own stage, and each stage needs different criteria to evaluate. And for a beginner, it will be good if you go into mature growth, mature, stable companies, and to a certain extent, high growth companies. Startup companies, young growth companies will be extremely highly volatile, and the way you will evaluate them will also differ very largely from high growth, mature, and mature, stable companies. The first criteria you may want to look at is economic moat. Without going into the technicality, this picture says it all. The economic moat explains the kind of business we need to invest in. Very strong business, very strong moat. That is, if some competition wants to come in, the competition should not be able to come in so easily. Now, a business can create economic moat by having a great brand, having great patents. You have example like Apple. They could have network effect. That is, if I'm using Facebook, my family will use Facebook. My friends in the US wants to use Facebook. So something the usage of one person leads to usage of another person, and this kind of a multiplier effect. The third thing it could be a niche business, a dominance. For example, Google has complete dominance in search business. There is nobody who comes near to Google. And if somebody wants to reinvent the search business tomorrow, it's going to be a lot of effort. So the first criteria is economic moat. Yeah. Similarly, the one of the example is Moderna, which has come out with the COVID drug. Tesla is another example. So such kind of companies. Number 2 is management. This is something which is very critical, and I really look forward to it. You got to invest with people who you can trust with your hard-earned money. People who are forward-looking, management which is purpose-driven, management which doesn't, care about the share price in the long run, who doesn't want to make people happy, but is more long-term focused, more business focused. They're trying to build a company. They're trying to build a great product. They're trying to build a great brand, and who have skin in the game. Now, if you ask me personally, I tend to look at founder-led companies more. I personally invest a lot more in the founder-led companies because, there is a great research from Bain and Company showing that the founder-led companies, they tend to outperform the rest because founders, they're in control of the company. They're passionate about what they're doing. They can call the shots. There are single decision making. There is lack of bureaucracy. But there are companies like Microsoft where you have CEO like Satya Nadella who are fantastic. Where, in Singapore, you have DBS Bank where Piyush is fantastic, has done a great job. So you can certainly find companies where the founders are not the CEOs, but there are CEOs with the founder mentality. Number 3. Now, I just want to repeat one thing that when you are evaluating a particular stock or particular company, it's always a combination of qualitative and quantitative factors. So I've gone through the qualitative factors, which is management and the economic moat, and I think they're equally important. Don't just get fooled by the numbers. It's very important who is managing the company and what kind of ecosystem the company has created. Is it strong defense or it's a poor defense. Now, third thing, you do want to look out for a company which is growing, which is where the top line is growing, because if the top line is growing, it's a good indicator that other measures will also be doing well. And there is enough research to show that revenue growth is a good predictor of share price performance. So I've taken an example of Facebook here, and you can see that Facebook is growing phenomenally well. Around in 2020 it grew about 20%. In 2019 it grew about 26%. You would want to look at the revenue growth of greater than 10%. Yeah. All this data is available at Morningstar, and I'll show you later, how to extract this data. Fourth thing, you may want to look at the company which is return on equity is greater than 15%. Now, without going into technicality, just understand that return on equity simply means that if as a shareholder, you invest $1, and a return on equity of 15% would mean that you're getting 15% back, or you're getting 15 cents as the profit. Obviously, higher the return on equity, better it is. But you do want to look out for the companies with greater than 15% return on equity. Again, an example of Facebook, fantastic return on equity. You can see that in 2020, the return on equity was 25%. You can look at the definition here, but I think what it means is more important than the definition. The next criteria you want to look at is return on invested capital. Now, return on invested capital, without going into technicality, simply means that how efficiently the company is allocating its cash or its capital. Higher it is, better it is. But something in the range of greater than 15% or 20% is fantastic. You do want to rely on a CEO as a great capital allocator. So this is again another example of Facebook where you see the return on invested capital is fantastic. The numbers are looking really, really great. 17% in 2019, 22% in 2020. So that is your fifth criteria. Now the sixth criteria is earning per share. Now we have seen that you want to invest in companies where the revenue is growing, but at the same time you do want to invest in companies where they are making money. Again, there are companies where the revenue is growing hugely, but the earning is not there. They're still earning negative. So I'm not saying that you should be investing in those companies, especially at the beginner stage. Although there is nothing wrong with that. If you have high risk appetite, you should. But just to play safe, you invest in companies which have revenue growth as well as which have positive earnings, which are making money. And the criteria to assess the earning per share is if the trend is growing and 5-year average growth is greater than 10 to 15%. So again, this is an example of Facebook where you can see that year on year, Facebook is growing. It's an increasing trend. Yeah, it's pretty much an increasing trend. And then if you see the average, 3-year average about 23%, 5-year average is 50%, this is fantastic. So it really meets the criteria. Now, I just wanted to bring your attention to this matrix, which is from Vishal Khandelwal, who's a great educator from India. He has drawn this matrix between return on capital employed and earning growth. And according to him, the companies which have return on capital employed of greater than 20% and earning growth of 15%, greater than 15%, they have high probability of value creation. So you can choose the criteria. I mean, I have talked about greater than 15% for capital employed. I've talked about greater than 10% or 15% for earning growth. But it's your money. You can be ambitious with that. So take a criteria of high return on capital employed, greater than 20%, greater than 15% for earning growth, and then you end up in this quadrant. But just I wanted to highlight to you that this is a proven research, proven track record of this guy who's giving you some advice, and you can take it seriously. The last criteria, which I personally give a lot of importance to, is cash flow. Now, there are two kinds of cash flows. One is your operating cash flow, one is your free cash flow. Now, operating cash flow is simply, it's a measure of, your company is generating on day-to-day operations. It just gives you an idea whether the company has enough money to keep running, whether it has ability to remain solvent. Now, that's a survival criteria, and that's a very important criteria. So again, I've taken an example of Facebook, and you can see that very robust operating cash flows. Now, free cash flow is even more important in bigger scheme of things, because the higher the free cash flow a company has, higher the ability the company has to reinvest in its future. Yeah. Now, it's great. It's an ideal situation if both operating cash flow and free cash flow are fantastic. They're great. Now, if they are not, if the free cash flow takes time to build up, then at least you should make sure that the operating cash flow is positive and it's increasing over time. Yeah. Now, let me just show you how I went about doing them, and how do you get information from Morningstar. All you got to do, let's say Morningstar, go into Facebook, Morningstar Facebook. It's all this data is free for you. Yeah, where I got this, and just going here. Going here in quote. Yeah, and go into key ratios, full key ratios. I'll give you a complete idea of where the company is. You see that this is all data which is free. Talk about revenue. Yeah, This is the Facebook data. The revenue is growing, as I showed you. You can look at operating cash flow here. You can look at free cash flow here. It's all increasing. It's fine. Yeah. You can look at the return on equity here, which I just showed it, copied and pasted there. You can look for return on invested capital here. And then, there are more deep dives also here. If you're looking for the earning per share, which we talked about, just click on this growth and you can see the EPS growth out here. If you want to further break down revenues, 5-year, 10-year growth, you look into this. Operating income, net income, you can take a look, but I'm just trying to make your life easier. Looking at revenue and EPS would be good enough at the moment. If you want to look at cash flow, just go and look into the operating cash flow, free cash flow growth here. Another financial health, if you want to take a look, you can take a look here. Debt over equity is another criteria, is a lighter criteria for me, and I'll talk about it in a while. And if you want to look at other efficiency ratios or whichever, you can look at here. Yeah. There is a angle and valuation also here, which I'll cover in another section. So just play around with it. You can see that this all information is free for you. You don't have to pay anything. And this information is good enough to make you some basic decisions. Going back to the presentation, these are the 7 criteria. So I'm just repeating: economic moat, management, revenue growth, return on equity, return on invested capital, earning per share growth, cash flow. Now, one thing, where am I at with it? And it's important since I'm the one talking about it. You probably could mix it with low debt also. You can look at the debt equity ratio. As long as the debt equity ratio is less than 1, you should go for it. Sometimes the debt is good because debt is taken, if you get it at a lower interest rate to expand the companies, it's fine. But if the company is over leveraged, obviously there is a bit of an issue. So look for a company with a low debt also. As I said, debt equity ratio of less than 1 is more than enough. Now, what I look for these criteria. And again, I want to repeat that these are mostly for the companies which are matured companies, companies which have come to a certain stage of growth already. For example, Facebook, MasterCard, Visa, Apple, to a certain extent, Amazon. These are the criteria for those companies. This is not a criteria for the company which has just started up, which has just got listed. There are a lot of companies which are not making any money, but are fabulous companies because they've chosen not to make any money. They've chosen not to earn any money because they're reinvesting in the business. So don't worry about that. Focus on these companies, the established companies, and they can deliver extremely good results. These criteria plus low debt. Now, what I do is I started with these companies myself, but I've sold most of these companies at a profit. I've sold Apple at about 200% gain. I've sold Facebook at about 100% gain. And I've reinvested that money into the smaller companies as I'm getting more and more confident about my ability. So I'll look at these financial measures. I'll look at the qualitative measures. But for me, the critical factor, what I look at is what can company become in next 10 years? I think it was important for me to talk about, what I am doing so that, there is no mismatch of, there are no double standards out there. So I look for companies which have high potential to grow. Apple, Facebook, MasterCard, Visa, all are great companies, but I'm not investing in them now. I used to invest in them. I'm looking for smaller companies, smaller entrepreneur-driven companies, which are into disruptive space and with an idea that where can I reach them in 10 years. So that's my way of looking at things now. But I did start with these companies. I did very well on these companies and earned some decent money on my small capital. So you may want to follow this. Now, what is very important is that we have these criteria. Now, on the basis of these criteria, how do we choose companies? That is an important thing. How do we choose companies? Which companies fit this criteria? So that's one thing. Second thing, price. What price should we pay for these companies? Because sometimes the price could be high, sometimes price could be low. If you pay high price, obviously, your returns will be lower. Now, these two things I'm looking to cover in the next lecture. I just want to keep it as short as possible. I'm not sure whether it was that short, but I'll come with episode 3 where I'll talk about how to choose companies, how to value the companies. Valuation is a very difficult, very subjective, very talked about topic. And it has been overcomplicated to a certain extent. It bugs me also a lot. So I'll talk about some of the approaches of valuation and how you can decide which stock to buy, which stock not to buy. So see you next time. See you soon. If you like the content, subscribe to the channel, follow the channel, talk to your friends, let them benefit as well. Write to me, give your comments. That would be amazing to hear from you. Thank you and take care.